Hey, Sean, thanks for coming on to the podcast today. Appreciate your time.
Of course, thank you. Beautiful day here in sunny Florida, so always good to hop on a podcast with you guys.
I feel like the timing was good as well. Just like end of year, it's like a lot of people start their goal planning in like January. It's like, dude, you're like a little late to the game. So it's like trying to remember, okay, last quarter of the year, tax planning, and we just had our call with our CPA 2 weeks ago. Just kind of like, hey, has anything major changed? Estate planning, like anything changed this year? Is like taxes, don't want to pay the government if we don't have to. So I was excited to bring you on, especially after hearing you talk at the Elite Investor Group. I think there was over 100 investors there. And it's like, I think as real estate investors, you can never have too much education around just taxes, how to defer them, how to just use your real estate properties, whether it's rentals or flips or new construction, like using that just to improve the lower the amount that you have to sort of pay the government and the benefits. And then you guys have the challenge of always keeping up to date every 4 years. New president or something comes in, you're like, oh, great. What crazy ideas do we might have to adopt? So I want to give you a chance to kind of explain what you guys do and the clients that you work with and how it benefits what they're doing in real estate investing.
Yeah, no, I appreciate that, and Jeremy, I appreciate having me on the podcast as well. Been a long time listener, first time caller, as they used to say, right in the radio days. So happy to be a member on here as well. But yeah, so I'm Sean Lichterman. I work in specialty tax incentives, and we primarily work with real estate investors to business owners. Essentially, if you're acquiring a tangible property, think a rental to multifamily to any commercial brick and mortar you see on the street, or if you're a business owner that's in a innovative line of work, tech or manufacturing or agriculture, we typically work alongside with you, your tax team, your CPAs, tax advisors, to uncover additional tax incentives. Be it cost segregation will be one of the topics we talk about today. If you're making capital improvements, there's way to either accelerate or expense or get some energy deductions back. And then finally, with business owners who are developing, new product processes and softwares, R&D tax credits, kind of the creme de la creme of tax incentives because it's a dollar for dollar reduction in your tax liability. We work within the accounting space. We're not accountants. I'm not an accountant. I'm not a CPA. It's kind of like the surgeon and the scalpel, right? We work very well together on their own. They kind of have their own responsibilities. But we do work alongside with CPAs. We have some internal accounting tax advisors that obviously go through our reporting to make sure everything's accurate, and so we can put our stamp of approval on it. But happy to kind of open up my world of tax incentives. I know the tax talk because sometimes it brings on glazed over eyes. I remember being in high school.
I was like, you have to keep the energy high because it's like, oh,
That's
people are like,
right.
taxes, or you started to fall asleep already.
That's right. Yeah. I mean, the tax talk, it's not a sexy one, right? People think
Yeah.
like dollars and cents or,
Dude, it's sexy when you're like,
depreciation.
oh, I saved, like if you came to your clients, it was like, here's that 500 grand that we just saved you,
That's
like in
right.
cash. They'd be like, oh yes, dude, yeah.
Yeah.
All right, dude, I
So
like you guys.
yeah, that's kind of what I'm getting at. Like we're the rock stars of the accounting world because
Uh,
we're always having that conversation with with investors, taxpayers, as well as their tax team saying, "Hey, remember that bill you had to owe Uncle Sam? Well, hey, we wiped it out or we cut it in half, so on and so
yeah.
forth."
What's like, uh, just to like, what's one of the clients, let's say in the last few years, where you just, man, it could be a smaller investor or just a bigger client, like kind of a study, like even if it was just one study, like how much have you been able to save that you guys are like, oh man, that was like a really great one, or just a great use case that you've had recently of like, man, we saved this guy, didn't even know what this study was, got educated, saving 10, 20, $50,000 on his tax bill.
Yeah, I mean, we got a Rolodex full of those. But yeah, I'd say one that's especially local. I won't mention any names, just for anonymity. But yeah, working with a software engineer, so bringing in a hefty income, making upwards $300,000 annually, and as a W-2 employee, you really are limited on ways to reduce your taxable income, right? W-2, right? So
Yeah.
you can either get a 401k to reduce it, maybe an IRA, or do some charitable contributions. I'm really limited in that regard. But real estate, and it kind of gets taken a little step back. The tax code is about, it's over 5,000 pages long. So if you've read every Harry Potter, you can pretty much read the tax code now. Whether you understand it or not, it's a different thing. But majority of that is actually dictated towards either real estate or business ownership in ways to mitigate or reduce your tax burdens.
Yeah.
That's where we really utilize
And
the
that's where
tax
like
code.
90% of our clients are like, not like, even if they invest full time, they're like, they still have a W-2, like many, many, many of them, like 99% are still working a job where it's like, yeah, like I'm getting smoked, in taxes, or I live in, a lot of our clients might be out of state. So like when I'm living in California, New York, and I'm getting smoked on these taxes, and I need something to help offset. So yeah, it makes sense why
Exactly.
W2 is such an important piece to look at. So sorry to interrupt.
Yeah, so that actually kind of brings us in maybe to our first topic, right? So they invested into a short-term rental, Airbnb, VRBO, right, a vacation rental. Florida's kind of a hot spot for those. And actually, within the tax code, if you participate, you manage your property, you put a X amount of hours, whether $100 or $500 annually, into managing it personally, you can actually take the losses or the deductions essentially from a cost segregation report, and then you can apply those to your non-passive or otherwise active income. So for this individual, we looked at two properties. I think it offset roughly $250,000 in deductions that he was able to apply to his non-passive or active income as a software engineer. So think about it from this standpoint. Here's a guy, he's in a high tax bracket, he's paying taxes out the wazoo. He invests into two short-term rentals, so he has cash flow coming in, so he's doing a good investment. But then by doing this cost segregation, this accelerated depreciation approach, he's able to also produce a paper loss to essentially reduce his taxable income, I mean, drastically, where that cash flow he can either repurpose, so reinvest into another short-term rental, which he did. We can, do some improvements, buy some technology, maybe hire out some employees, but it's essentially it's taking money from this pocket that you otherwise would have owed to Uncle Sam, and now you get to put it back in your own pocket and reinvest it for something else, or back in the market.
So if somebody has like a single family house or just bought, 4 units, 10 units, something recently, does it have to be a brand new property that's like ground up construction to use cost seg? Can it, like, how does somebody start to identify if it's something that they should even do and if it's viable to look into cost seg? And then what goes into completing the study once they hire you guys?
Yeah, and maybe I'll back up just a brief definition of cost segregation for anyone who's first time hearing this word. I know it is kind of growing in popularity, especially between the Tax Cut and Jobs Act, the bill passed, bonus depreciation is a big household term. But cost segregation, it's just an accelerated form of depreciation. So whether you own a rental property or commercial property, you have to depreciate that. And the IRS knows that there's going to be some wear and tear involved. So for a residential property, so say like a single family home, long-term tenant, you have to depreciate that property over 27 and a half years. Commercial property is 39 years. So essentially, you get either 127 and a half or 139th of that tax benefit each year to reduce your taxable income. It's kind of like a long drawn out tax benefit. That's Uncle Sam's way of saying, hey, thank you for stimulating the economy. Cost segregation, we're ramping that up. We're throwing kerosene on the fire.
So you're like crunching that time frame to where they can
Exactly. Yeah.
take more of the bite in a shorter period.
Exactly. We're front loading it. So rather than waiting 30, 40
Gotcha.
years, things like your wallpaper, your carpeting, your crown molding, some land improvements if you have a pool or a patio, a lot of those assets have a shorter depreciable lifespan, 5 and 15 years, for instance. So kind of just from a 30,000 foot overview, it fundamentally makes sense to put assets within their proper classifications. If I have $100,000 worth of carpeting, why would I depreciate that over 27 and a half or 39 years, right? When I can do it 5 years. So that's really the concept of cost segregation. And by doing so, right, you're being able to access these deductions early on, which then you can offset your tax liabilities. You can utilize that cash flow to reinvest, repurpose, do as you please.
Does it have to be like somebody buys a property? Can they do it right away, or is it they have to have been the same person to pay for those repairs? Like, hey, you have to actually put in that kitchen to do the cost seg, or can they buy basically a fully remodeled property and say, hey, here's all this brand new stuff to like be able to use it?
So actually a little bit of both. Yeah. So you asked like when's a good time to do cost seg? Really, the best time to do cost seg, or at least to look at an estimate. So there's many different names. You can look at a feasibility estimate or an estimate of benefit. Essentially, we take a soft analysis of the property. So if you're looking to acquire property or you have acquired a property, those are really the best times to take a look at one of these estimates to see what your potential deductions are. Because at that point, we can get with you, your tax team, and understand what's your tax planning, what's your strategy, how long do you plan to hold this property, what's your tax obligation this year, and that way we can really plan in that deduction, right? Let's say we just acquired a $500,000 single family rental here in Wesley Chapel, and let's say that's going to produce $80,000 to $100,000 in first year deductions. By looking at that estimate in the first go of it, I can sit with my tax team and say, okay, by utilizing this study, how is this going to generate additional cash flow? How is this going to help my strategy, my planning? That question of when to do it, sooner is always better. But even if you miss the mark, let's say you have a property you purchased 5, 8 years ago, We still do these. They're called retroactive or look back studies. You can still look back. You can catch up the depreciation missed. You just file a new form of
Is
change
there
of
a time
accounting.
constraint on that? Like, hey, if you bought a property, you have to do it with, at least within the five previous years of owning it, or do you think?
Not necessarily a time constraint like within
Okay.
the tax code, but because of cost seg, because we're looking at 5, 7, and 15-year assets with that type of lifespan, the
Yeah.
longer you wait, after 10, 15 years, the less meat on the bone, so to
Yeah.
speak, there is to
So you
accelerate.
guys
So
are you're coming in and you're pretty much putting a value on literally everything at the property inside and out.
literally everything. Exactly. Yeah. I mean, everything from the specialty electrical wiring to the plumbing to, the fixed assets to the tangible assets. Yeah, everything is going in there, which is why they're typically done by engineers and not so much the CPA. That's really our relationship with the
Yeah.
accounting industry.
Interesting.
It's
Okay.
kind of one of the ways, like to say amongst, my network is like, if if I have a broken arm, I'm not going to take it to a proctologist to fix, right? Yes, they're a medical doctor, but it's not within their field.
Right.
Somewhat similar for a
Just a specialty
CPA.
here. Yeah.
That's right. Yeah.
Yeah.
The surgeon and the scalpel. Yeah.
That makes a lot of sense. And so somebody comes to you guys, wants to have an initial call. You guys sort of, take a look at everything. What's kind of timeline to schedule out and complete a report? And like, is there going to be any work required on the person coming to you guys to like prepare anything? Like maybe some records, like here, this is what I spent on this renovation or anything, or is it, it's pretty much, hey, within a 30-day process, we can get out, take a look at the property, get some reports back, and then what's maybe, and I don't know if the pricing changes by and I don't have to put you sort of, in stone on what you say, but, I'm sure it depends on the amount of work that goes into how big the asset is. But if someone's looking at, hey, I just bought this $500,000 house, what could a general range be to expect to pay for something to see, okay, if I pay a couple grand for this report, and then I'm going to get, maybe 20, 30 grand worth of benefits, that's like a no brainer, right? On like savings. So walk us through just maybe a couple thoughts there.
Yeah. So first off, kind of the time frame or time expectancy from like a potential client. Not really a whole lot outside of if you just acquired a property, right? We'd like to take a look at the settlement statement. What did you actually purchase acquire this property for? If you've owned this property, you've been depreciating it as a rental or as a business, previously. Depreciation schedule often helps because it breaks out the building value and lands. Kind
Okay.
of a little carve out is that land is non-depreciable assets. So whether you're looking at a rental property, a commercial property, we have to assign a value and essentially take that out from the basis. So yeah, there's probably a little bit of back and forth, especially if you did some large renovations, improvements. We want to take a look at. Often the times it's called a pay application from a general contractor. If you use an architect,
Mm-hmm.
architecture firm, it's called an AIA ledger, or you can just simply break it out. If you have invoices, receipts, we can take a look at that as well. So it really just depends on the type of property, the project, which also kind of goes into the type of benefit, and then ultimately kind of the study fee associated with it. There's not really a one size fits all in terms of pricing or study, but in general, the ROI is it's phenomenal. Like what you're paying for the actual study and what you're getting on the back end for deductions, especially now that we have 100% bonus back in play. I mean, it's just mind boggling. The
Yeah,
fact that some people.
can you walk through that, the how that's back, or how it was potentially like, not gonna be a thing? Can you just walk through, like, what sort of that is and
Yep.
what's back on the
Yeah.
table?
So bonus depreciation, I mean, this is bonus and depreciation and cost variation. They go together. It's like $2 Taco Tuesdays on tequila night. I mean, they just couple together so well because bonus depreciation allows you to write off those eligible assets within the first year. So now that we have 100% back in play through the big beautiful bill, it just got signed into to practice on July 4th. So while many of us were having hot dogs and shooting off fireworks, me and a few other industry nerds were waiting for this to get signed into place. That was my 4th of July. But yeah, so essentially why these go hand in hand so well is because a cost seg, we're looking for those 5, 7, 15-year assets. And the bonus allows you to immediately write those off. It's been stamped back in the tax code. It's permanent. So there's no phase out. There's no sunset, which we had, in the prior tax legislation. But why that's so significant, let's go back to the example. Like we bought a $500,000 single family rental. Let's say we found that a quarter of it, 25%, is eligible for those 5 and 15-year items, right? I'd be able to write 100% of that quarter of that eligibility off in the first year. So that could be $100,000, or
Mm,
more, first year tax deduction, which is phenomenal, especially, if I'm an investor that's trying to grow my portfolio. One of the largest hurdles for you is your tax burden. your income tax burden. Or if I'm utilizing maybe like rep status or a short-term rental strategy, I can also now utilize that against my non-passive income. So it gives you a lot more strategy and planning to use your tax bill in a way that you just didn't have before or prior.
Yeah, does they so in that same example, someone maybe has 100 grand of benefit, but let's say they only need 50. Are they able to do like 50 this year, 50 next year, or they basically just have to show like just take the full thing? Or is that more of a CPA kind of question?
Well, yeah, actually, a little bit of both. Yeah, yeah, you don't have. It's not a use or a lose. Let's start there. So it's not a use or lose it. If you have 100,000 in deductions, let's say you only need 50, perfect. You've wiped out your tax obligation for that tax filing year, and you get to carry forward any of the unused into future or
Okay,
subsequent years.
cool. And that
Yeah.
goes
So,
up
so
until like, is that for pretty much until it's all used up? Whether it's like you use, if you didn't need it, the next year you only need 20, and then you still got 30 grand left over for the third year. Is it pretty much there's no time constraint on how long that can sort of be used up until it's fully used?
exactly. While you own the property. Yep. Yeah. So you can't sell the property and then
Okay.
kind of carry this forward. Yeah. So it sticks with the property and with the ownership of it.
Okay.
But then keep in mind, right, we've accelerated roughly a quarter of the value, but each year you're still going to get your straight line depreciation. So you're still going to get an added
Okay.
value each
Yeah.
year to some aspect.
No, that makes sense. And do people have to like own the property in an LLC to take advantage of cost seg, or it's just all done at sort of the personal return level, or does it matter?
Right, right. Yeah, so you can cost seg regardless of the entity structuring. If you've got multiple partners, if you're a C corp, if sole proprietor, or you do LLC, that is where we're going to start, stemming into the CPA accounting tax
Yeah.
advisor, where they're going to want to speak with, those individuals, the benefits of maybe putting a rental property into an LLC than say, owning it outright, right? You get a little bit more protection,
Yeah.
from an investment standpoint. But in terms of, cost of eligibility, it's
So
immaterial.
if there's three investors, they all own a third in an LLC, and they do this study, they basically all get a third of the benefit in essence.
Correct. And again, that's gonna that there here's where, our role and then a CPA
Yeah.
role really team up because depending on some of those investors, some of them actually may materially participate within their own rentals. So they may either qualify for rep status, real estate professional status, which allows them to then utilize that loss against their own tax benefits. So yeah, that it's kind of it may be a little bit gray area, but that's where we would like to work with the tax team to make sure that if you have multiple investors, especially in one project, it makes sense to review to how can you utilize this to its fullest potential.
That makes sense. Is there some like common misconceptions that you know, you guys get where you're always having to sort of battle, oh, this isn't exactly how it works, or what's some of the education challenges do you think for like the general public that just like haven't even heard of this thing before and trying to understand like how does it fit in? Is it right for me? Like, there's something that comes to mind for you on something that you're constantly having to educate people on, or maybe something they heard that's like incorrect? You're like, all right, these gurus online need to stop like picking this one thing up. It's like it's not exactly true.
Yeah. Yeah, go buy a G wagon. Utilize bonus depreciation right off all your income. I mean,
Buy a
again, I'm not a CPA tax.
thousand pound tank so you can just write off the whole thing.
That's right. Yeah. I mean, even though I work in tax incentives, right, that is our ploy, we still follow the mindset of don't let the tax tail wag the dog, meaning don't invest into properties just for the large deductions, right? It also has to pencil out on paper first. Think of this specialty tax planning, cost like energy R&D incentives really as the cherry on top of
Yeah.
the investment, right? So it has to kind of pencil out first and then you can kill enemies.
Yeah, no, yeah, I've always thought it's kind of funny where people are like, unless you really need like that car example, is like, why would you go buy a brand new car just to save a little on taxes? Like, never kind of made sense to me. So I appreciate you bringing that up because it's, you know,
Right.
the the investment has to make sense. Like that's where the taxes and everything is just the sort, like you said, just the sort of benefit on top. Because if you're not able to cash flow just from day one, or hey, it's going to take 12 months to stabilize this and whatnot, you know, you want to just make sure that's making sense first. How would it, so with cost seg, just to get a little bit more niche, maybe. So if, let's say you have an investor that's going to raise some money to do a project, and there's maybe general partners who are like really controlling the deal, and then maybe there's limited partners, like they had a couple family members put in some money. Someone, if the sort of general partners in the group do the study, can the limited partners that are only putting capital in but they have no day-to-day operations, is there a chance that they get any benefit of that, or does that roll into kind of just the general partner level.
Yeah. So what you're kind of explaining is really like syndications, right? So you have
Yeah,
multiple
correct.
investors, some on the GP side, some on the limited partnership side. To answer, yes, everyone's going to get their chunk or share of the paper loss, the deduction, typically in a form of a K1. Now, how they can utilize that loss or their personal chunk really then is going to derive on a couple of matters. Again, how much was their investment? So what portion comes back to them? How is the structure of the investment written up? Does someone assume some debt or liability on the syndication, especially on the GP level? But depending on how those LPs or even GPs can utilize that loss or that deduction, is really going to boil down to really their makeup or their participation within other real estate businesses or trades. Again, kind of going back to that real estate professional status. So I'll give just a quick carve out of that. This is a really cool strategy for those who are 100% within real estate, buying, selling, acquiring, building, constructing. There's a number of activities that qualify. And as long as, over 50% of your time is within this business or trade, and that you're allocating at least 750 hours annually to these operations, again, you can then take the losses and apply them to your non-passive income as a limited partner or GP within one of these syndications. A lot of people do invest kind of passively, but because they have other operations, maybe their own rental properties, maybe their property management group, depending on meeting that qualification, they can then use that loss against their non-passive income. Otherwise, like myself, I participate in many syndications. I don't qualify for real estate professional status, so I kind of just have a bank of passive losses just sitting
Yeah.
waiting to be used. But yeah, passive losses, you're just pushing forward. So yeah, not everyone gets to utilize them equally. It really just depends on your makeup and your activity within the industry. But everyone does get their fair share. If you can use it or not, it's kind of the back
Yeah.
end of it.
Yeah, no, that makes sense. Um, for let's say somebody's, buying a commercial property and wanting to evaluate different, like they're going to do some capital expenditures. They want to come in, maybe do some big improvements. Do you guys have a way to, sort of give them an idea of like, let's say, you know, they want to put in $100,000, like it's a multifamily property. They want to put in $100,000, common pool. Could they come to you and say, "Hey, I'm thinking about doing these bunch of these improvements, based on maybe a cost segregation study that you've done in the last year or so? Could you give us an idea what this value would be on the report if we hired you guys after, like sort of almost like proactively trying to get an idea of some of the tax benefits of like, hey, we plan to do these improvements anyway. Is there any easy way to kind of get an idea, maybe some of the like if they just put it in that year, does that mean, hey, that's going to be 100 grand on your report? Or you could say, hey, they spent 100 grand, but market for that is actually 150 for a brand new pool based on like, how do you guys come up with the values attached to the different things? Is it based on like national reports of like, hey, this is average cost for like these items, or like, how, what, I'm sure it's in a software, but you have any clients that are like really proactively kind of like plan like that? Like, hey, we're thinking about doing some of these improvements. What might the trade benefit be on the study? And maybe, I don't know, a little proactive, like kind of different approach around that thought.
Yeah, this actually kind of ties into like the one of the previous questions of when's the best time to look at a cost seg estimate or a cost seg application or eligibility. And most people, they probably with their tax planning are more reactive, right? They get
Right.
to March, April, or if they file an extension, they get like maybe a month before and say, "Hey CPA, what's my tax bill? How much do I owe? And then what can we write off?" And they
I
go,
didn't
"I
do
don't
any.
know."
I didn't do any of my books all year. Can you help me out?
Right, exactly. Whereas cost seg, it's a really good proactive planning tool and strategy that you can utilize, time and time again, especially if you're acquiring multiple properties or you're doing these large scale capex improvements. And we see that all the time in certain industries, right? Multifamily, there's typically a refresh every 8, 10 years.
Right.
Auto
Yeah.
dealerships, they have rebranding refreshes, hotels. So there's a lot of industries that are doing like kind of these rebranding refreshes where they're putting a large sum of money into it. So yeah, on the front end, we can look at, that's kind of what we're doing in this year. If we had individuals who did a cost seg upon acquisition, maybe this year or last year, and they're planning for a large capex improvement, we'll take a look at those renovations, those plans, those drawings. Again, they have the pay application from the general contractor or an AIA ledger from an architect firm. We can essentially break out all those assets and give them an estimate, essentially prior to doing the cost seg of if you're going to spend $500,000 in putting a pool, maybe some paving the parking lot, you're going to put some specialty equipment in there, some furnishing, things of that sort. Here's the amount that we estimate that you're going to come in at to be able to deduct if we do this study. So yeah, it's a
Oh yeah,
perfect
that's nice.
planning tool.
Yeah, in my head, it's like I kind of think of it around like, oh yeah, either something I owned or something I'm buying, but I didn't think about, if somebody's actually holding this thing for long term, like you mentioned, the market might dictate that, hey, we bought this 5 years ago, we did a study, we did some stuff then, and now it's like we're having to, rebrand the community, we're going to paint it, we're going to like really sink some money into it, being able to basically do like a part two with
Hmm.
you guys because you have maybe the study from originally from it, and then you can at least analyze the new improvements that they're doing. So I hadn't thought about that as a way to
Yeah,
also
and then
utilize.
and then how we derive really the values. So we break everything down into its what's called a unit of property format. So every nut, bolt, specialty wiring, furnishing, that all is going to get reviewed and allocated a certain value. So the values, the way that those get determined is going to be dependent on the type of project we're looking at. Is this new construction that we can work off? Really, the plan builds, the drawings, the costs allocated. If it's an acquisition, an appraisal always helps, right? Then we can use that in conjunction with what's called the modified accelerated cost recovery system, which helps us allocate a lot of those values to those assets.
Okay, yeah, that makes sense. Is there a couple documents that somebody could do proactively to maybe help? So you mentioned appraisal, right? So let's say somebody bought it 3 years ago. Would it be a benefit for them just to pay for a private appraisal to sort of come up with maybe a value that would help you, or can you use like a broker price opinion, or could there be something else um, where someone comes in and does a little bit, or like a home inspection to bring up anything that you're like, hey, here's a bunch of stuff that like maybe the client bought it sight unseen. They don't really know the age of
Mhm.
some different things or the age of the roof. They're not really sure. Their permits online don't really match. Like, is there any quarter like 4-point reports, inspection reports, appraisals, or a few documents people could pay for up front before they come to you that might just give you a little extra juice?
Yeah, exactly. An appraisal is typically going to help. The more key documentation that we can have allows our staff, our engineers, to when they're actually formulating the values, to not be as conservative. That way, when we, say you've got $100,000 worth of, flooring within this property, we can be confident, and should it ever be reviewed, we can stand up against that in the form of a defense. And that's going to change between asset classes too, right? So depending on what asset class you're looking at, single family homes, multifamily, say a medical office, for instance, there's going to be a different amount that we can allocate to those eligible assets. Across the board, I think everyone just says roughly 20%, 25%. That's kind of an industry average, but it does fluctuate. There are asset classes like mobile home parks, for
Mm,
instance. I mean, those we can essentially, typically 45, 50% or higher, depending on the breakout of ownership on the personal units of the pads that the mobile
right.
homes
Yeah.
sit on.
Yeah.
Those can be high. Car washes, gas stations, medical offices, self storage, right?
Mm,
That can vary quite a bit on what we can accelerate, because is it just a self storage lot, gravel lot, or is it
all right.
multi story? Is there climate control? So that's kind of the things that the engineers are looking at. And especially if you have an appraisal, if you have any blueprints, drawings, that helps a ton.
Interesting.
For a lot of our projects, we do a site assessment. So we actually send an engineer out there to walk the physical property, take
Okay.
notes, take allocations, because what you see online or what you see on paper is not always what you see
Yeah,
in
dude.
reality.
Public records doesn't show this in the back. Like
Yeah,
that's why its taxes are so low. Just like a survey or elevation certificate, any of that stuff probably doesn't really matter too much because you're not looking at the land necessarily. It's just the just the structures.
exactly. Yeah, an appraisal, blueprint drawing, those typically good if you're doing improvements. Pay application, that we can break out the cost to the improvements.
Okay. Yeah, because I think the first thing that comes to mind as far as like pricing is I think of like when we've had to hire public insurance adjusters, they come through and might use a software like Exactibit where it's like, they're trying to account for every little nail in the
Hmm.
baseboard, and come up with this huge thing to go to the insurance company on your behalf to be like, hey, your insurance offers was a pretty low ball to, put this house back together. Here's what's more realistic. That's kind of what I think about when you guys come through and you're like literally looking at every little thing at the property to put a
That is
value to it.
essentially what we're doing, but except we're saying, here's the amount of money you can put back in your pocket.
Yeah. Here's all the here's all the savings that you have.
That's right.
No, that's
Yeah.
cool. Was there anything else with the tax changes, like, in the last year or 2 other than, like, bonus depreciation that kind of applies for your guys' line of work, or is mostly related to that piece of it?
I mean, that was a pretty significant one. We did see quite a bit of extensions, from the Tax Cut and Jobs Act, right? Same administration, so they're kind of extending a lot of what they already proposed back in 2017. We saw the new line item Trump accounts. So if you have had a kid this year, or I think in the next few years, you get to qualify. We did, so I'll be looking into that, how we
Yeah,
can invest or get our $1,000 from Uncle
yeah,
Don. But yeah, outside of that, so we talked a lot about real estate, but also in the business world for R&D tax credits, Section 174 has been repealed, which was a big one. The way I can kind of uh, explain these similarly, especially if you're familiar with cost seg, real estate, bonus depreciation having a phase out. Uh, for a few years, the last few years, there was actually a phase out within bonus depreciation. So essentially, instead of getting 100%, it brought it down to 80, 60, and 40. It was kind of, it was sunset. With R&D tax credits, it's very similar. So the way that you get this incentive is not based on tangible property or like having a building, but on the products or software that maybe you're developing, enhancing over time. So you actually can get a credit, dollar for dollar reduction on some of the expenses, the wages put into that activity. So in the previous years, you had to amortize, or essentially you got 1/5 of that tax benefit when you applied for the R&D. So going forward, kind of like 100% bonus coming back, now you get your whole lump sum. So yeah, a lot of changes, very taxpayer friendly, especially on this front for business owners, real estate investors. You essentially get to take your whole incentive and do what you will with it. So it helps with planning, helps with strategizing. Certainly with cash flow, helps to offset a lot more tax liability than in years past, which then you can repurpose and do what you will with it. Acquire,
yeah.
grow your business, innovate.
Yeah, that's I had heard about that recently was, if your company makes maybe a physical widget, medical devices, or just something like, maybe a pool cleaning company is making their own pool cleaning solution, or maybe you hire a consultant or some sort of firm to build out your own proprietary like technology, something like that.
Mhm.
Is that stuff that would basically qualify as like research and development or R&D and, that somebody might be able to utilize?
Yeah, certainly. And when you first think of R&D, you think of, chemists and lab coats.
Yeah,
You're like,
dude,
I'm
I know.
not doing that. How does that apply? I'm making widgets here, or I'm a manufacturing, I'm growing my process here, or I'm a software company, diving into AI. But it's actually applied R&D. So it's not the crazy chemist in the lab, mixing beakers and stuff together. I mean, although that is a portion of it, you could be doing that. But if you're like a winery or brewery, for instance, those do qualify
Yeah,
for
cool.
applied R&D. But yeah, manufacturer, software tech, agriculture. If you are doing some type of aspect of growing, innovating, enhancing a product, process, software, technique, formula, as long as it's touching upon one of those, and you have expenses, wages, contractors that you're paying for it, we'll often same thing. We'll look at it. We'll understand your process. We'll do a feasibility estimate up front to understand what you can potentially claim. And then in the actual study, we go to substantiate all that.
Interesting. Okay. Yeah, it'd be good to know if some of our clients that are in maybe the trades or, some of our clients, are have a construction company or AC company, might be ways that they're able to
Yeah,
sort of
engineering
dip into
firms,
that.
architecture
Yeah.
firms, especially if they're doing like design build, they're kind of on the hook for some of those design applications. Of course, yeah, yeah, or they internalize the software. It's definitely worth looking at. I mean, there are plenty of instances where we work with companies that one, we can cost seg the physical building that they acquired or put improvements into, and then because of the nature of their industry, they can also get a tax credit from an R&D side.
Hmm.
So that's pretty cool when you start stacking a
Interesting.
lot of these
Yeah.
strategies. They don't have to only be done, by themselves, which is what I like about our industry, because we're constantly, working in the lines of the tax code, but then we're also working with tax advisor groups and their teams to strategize either when to stack these allocations, these incentives, or when to plan them out, depending on, your ownership life cycle.
Yeah. Yeah, that's helpful. My wife's actually is an architect and has a company here in Tampa, and we do a lot of work for new construction, commercial stuff mostly is a lot of what we're doing. And hadn't thought about looking into that side of things. So that's helpful. That's one thing that's like, there's just like I mentioned earlier, so much to learn, keep up with when it comes to
Yeah.
taxes and this stuff. It's like just always a good refresher on,
That's why I say like the tax
saving
talk
money.
is usually not a sexy one, but like what we're like the rock stars, because I hear like your wife working as an architect or engineer. If you're working on tax exempt, say, or government type of commercial buildings, um, any of those projects can actually qualify for an energy efficiency deduction. It's called
Gotcha.
179D, and we talk about that offline. But
Yeah.
even for those who aren't owning property or working, in the R&D space, like your wife, for instance, depending on some of those tax exempt or government buildings, they may be able to actually receive that deduction via an allocation letter. So that's why our minds are constantly racing when we see,
Yeah,
did you acquire property? Did you make improvements? Do you work on tax exempt government buildings as an architect, engineer, designer? Are you in a space that you're constantly innovating? The tax code could be so helpful for a lot of these individuals where that's our role. And
yeah,
many people put that on the shoulders of the CPA, which is not always fair because not all CPAs are either experienced or have the knowledge within a lot of the
sure,
scope that we do.
right,
Outside of like maybe the big four
yeah,
CPA firms because it's all internal, but if you're working with like a small, medium-sized firm, it either A, could be too costly for them to take it in, or two, right, it's just not within their wheelhouse, right? They don't all have to be real estate experts, which is why we work so well in this group because we're able to offload a lot of their heavy lifting and work in tandem so well where we essentially make them look like rock stars because the client comes back and says, thank you for finding me X amount in savings this year. Let me go buy another.
yeah. That's kind of where I feel it's important for us is, I mean, obviously real estate investors, but like having the property management companies, like sometimes, new clients, they might just have one house they just moved out of. They're just trying to rent it out. Like they're like so brand new to the whole real estate investing thing. Like, what? Yeah, I didn't know I needed an LLC or that maybe I should have an LLC to hold it in, plus like all the other stuff. And so it's like I feel like it's our job to be educated, do these sort of things where we're learning from you guys, because even though we're not the one that's, filing their taxes or whatever it is, it's just a piece of the pie. So when it comes to estate planning, when a new client comes on, it's stuff that we recommend. Like, hey, when's the last time do you even have an estate plan? Like, for your family, for your real estate, have you done like any sort of asset protection? Consulting with an attorney. Do you even have a CPA? Still doing on TurboTax, right? So it's like just kind of trying to educate, or when was the last time you reviewed this stuff too? And I think that sometimes they may not know about it, but I feel like that's our expectation of ourselves is like we need to be educated enough to at least give them an idea on some things. That's even just when like short term rentals, like even though we don't
Mhm.
manage those, like we work with a company that we refer a lot to, so we're pretty educated on a little bit of the industry. We have some properties that we co-manage long term, and they do the short term on and some multi unit. So we see some of the inner workings. So like we'll get those calls from people that are like, I'm thinking about doing short term. And even though we don't do it, we can sort of say, hey, this is all the things you need to be thinking about. So it's like, I
Mhm.
feel like we're just kind of quarterbacking, like, here, these are just some ideas. We would just want to bring it to your attention so you have, that it exists and just pairing you with the right team. So that's kind of why we're always trying to stay educated on what's changing so that we can make sure our clients also know about the benefits that they have. It's like a software where you're paying for it and you don't use like 50% of it because you don't even know it's there.
Yeah, exactly. I think kind of, in my mind, it always comes down to kind of like the seven P's, right? Proper planning prevents, poor performance.
Yeah.
So it's always good to be knowledgeable, especially because the tax code is ever changing. And we're maybe that much of the tax code too, right? Then you can get into your state plan, you can get into lending options, you can get, I mean, it's just
Yeah.
the tip of the iceberg, which is why I love cost seg so much because it really is kind of I call it the eighth wonder of the tax world. It's your gateway to higher level tax planning, especially if you're a new to the scene real estate investor, whether it's your first rental property, Airbnb property. You're kind of getting into the concepts of depreciation. You can get into expensing, repair regs, and it all kind of really stems from that cost seg discussion or really getting briefed on it. And then your mind starts going wild. You're like, wow, now I can go into some additional avenues. You start looking at energy deduction, you start looking at R&D, you start looking at these estate plannings. I like to think of it, Warren Buffett, said it best. It's not about how much money you make, but rather how much money you save. And
Yeah.
I think that's so applicable within our industries that everyone's so focused on, obviously revenues, generating sales, which is very important, but they always either forget or they make tax planning, tax strategizing a reactive approach when,
Yeah.
again, don't let the tax tail wag the dog, but don't forget about it entirely as well, because
Yeah.
that can really help leverage and create that bootstrap that cash flow for further growth as well.
Yeah. That that makes sense. I guess maybe one kind of last question. Somebody does a cost segregation report and then they end up selling the property. You mentioned before that they can't maybe continue with some of those benefits after they sell the property, right? Can they? Is there any way to transfer that to the new, like to a new owner? You could say, "Hey, we did this report." There might be some, like, could the new owner possibly use the report, like for something for them?
Well, no, not in that manner, but you can cost seg the same building over and over. So, I mean, it's kind of cool. We're doing a project downtown Chicago. This building may be 100 years old, and it's past ownership probably 100 times as well.
Yeah, each new owner can
Each
basically
owner
do it.
can come in. Exactly, yeah. So while you can't pass it down, the new owner can come in. They can put some new paint on the walls. Maybe make some improvements, maybe gut it, for
Yeah.
instance. But they can take advantage of it. Yeah.
Interesting. Yeah. Yeah, I don't think probably many brokers are talking about that as like a benefit. Like, hey, just a reminder, you buy this thing and it's end of the year, rush and get a report done, slap some stuff in there,
Yeah.
some
I
extra
mean,
benefits.
brokers are a great referral area that I work closely with because one, they have such high transactional volume, but then two, it really benefits them because by being that kind of jack of all trades, by either having like a lender on speed dial, it costs like a CPA, maybe a title group on speed dial. It allows them to one, stand up as more professional within their industry, but then two, we saw this a lot in the previous years when interest rates were very high, especially when certain asset classes weren't kind of penciling out, they didn't
Yeah.
have a favorable cap rate. We were able to show a first year deduction amount, which then made some investors kind of oversee or kind of accept the cap rate, but then knew that they were going to get maybe
That's
$1 million
just what I'm
deduction that they could
thinking. It's
offset.
like, somebody that's, oh man, we're gonna have to stabilize this for 12 to 18 months and like the
Mhm.
cash flow kind of sucks year one. But like, or maybe it's just an okay deal and they're looking at a few deals, they're like, they all look sort of about the same. But there's one where they're like, the report doing his doing the improvements in the cost seg, they're like, oh yeah, like this could actually be a pretty good one because we are expecting, maybe we sold a company, got a bunch of taxable income this year.
Mhm.
So like we were kind of thinking about not to make the tax piece like make the deal good, but it's like, okay, now it kind of sweetens the deal. Like, yeah, this really makes sense now that we're kind of thinking about like this, get this extra benefit from the tax side versus just like based off the cap rate alone is like the decision for the investment.
Exactly. Yeah, it's something to just consider, at least look at, especially if you're looking at your NOI, your IRR, and your cap rate on a particular deal. What's my first year deduction? How maybe can I utilize that to offset some tax
Hmm.
liabilities to use as cash flow for maybe this project or a new property?
Yeah.
So they all kind of tie hand in hand.
That's good, man. I appreciate your time today. How would people get in touch with you if they wanted to chat about different things, maybe hire you guys, or what's the best way to stay in touch?
My cell phone, or my email. You can also follow me on LinkedIn. We do a lot of these webinars, whether CPE or even educational. If you're local in Tampa, we do a lot of speaking engagements with CCIM, James Lasar's group, many other real estate investment groups here locally. But yeah, feel free to reach out. A lot of my day really is conversations on one, what is cost seg? Two, let's look at an estimate, and then three, how do we plan this strategically with your goals, and then ultimately let's roll out the study. But yeah, whether it works today, tomorrow, this year, or maybe next year, it's always good to look at your potential tax benefits while you can, especially if you acquired a property or even own a few properties to pull forward some deductions. We kind of talked about all the benefits, so I'll leave maybe just a little, part of just, this is not, sliced bread where it's the next best thing since kingdom come. There are some scenarios where, right, it may not make sense. Again, cost seg, we want to offset tax liability. So if you don't have any taxes to offset, again, I'm just kind of creating deductions for you to store in a bank. But it's always good to work, or if you're going to sell your property or own it for maybe a short while, maybe 1, 2, or 3 years, we want to look at that amount of time you plan on owning the property, because if you are going to sell the property shortly after you acquired it, kind of do a fix and flip, you're
Yeah.
going to get hit with something known as recapture. So you asked about misconceptions within the industry. The first one is probably going to be recapture. It's the biggest one we hear. So it is something to strategically plan around. Quick, back end of what recapture is. Essentially, when you do a cost seg, it's like an interest-free loan from the government, right? You accelerate all these deductions. Uncle Sam says, here you go. You did this cost seg report. Good on you. Go utilize it. But when you go to sell that property, Uncle Sam says, hey, remember that loan we gave you, that interest-free
Mm-hmm.
loan, the deductions? Yeah, we're going to want some of that back. So depending whether you did the straight line or if you accelerated model, you can pay that back as high as your marginal tax rate. So it could be kind of a hefty fine, or not a fine, but a hefty,
Yeah,
payment
it's just
back.
some unexpected thing. You're like, oh man, I didn't I forgot about that.
Now, depending again how much time you've had, so if you've held the property 5 or plus more years, we plan to hold it longer, right? The time value of money concept really, breaks in.
Yeah.
My dollar today is worth more than my dollar tomorrow. So if you've held your benefit longer, the recapture is not as much of a pain point. Or, if you kind of do the buy, defer, die method, you go to 1031 route, you kind of kick the can down the road. So there are ways to mitigate the recapture. So first thing is, yes, be mindful of recapture, especially of how long you plan to hold the property, especially when you're using a cost seg. But it's not the end all be all. There are many avenues to mitigate or at least reduce a lot of that burden, come time when you decide to sell or take, kind of the proceeds and run.
Cool. I appreciate your time today, man. Educating us, and it's always a good refresher. Appreciate you coming on the show.
Yeah, well, thank you again for having me. Yeah, appreciate this. And again, if anyone has any questions, wants to reach out or just talk tax, happy to do that. Or shake my hand at the next, upcoming one of the real estate investor meetings.
Come out, buy you some
Happy to do that as
beers.
well. That's right. Yeah, you're
Cool, man. I
great.
appreciate it. Thanks, man.
All right. Well, thank you again.